You can stick with a hardwired strategy when it comes to investing. Choose the stocks you like one by one, or select Sector Spider ETFs and add the diversification of an entire sector of the S&P 500, like technology, with liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
If you own the Pimco Total Return Mutual Fund, ticker symbol PTTRX, and plan on holding it, please keep watching. The good news is Bill Gross will no longer torment you with his naughty boy billionaire to antics. Now the bad news is a mammoth 2014 tax bill probably awaits you. Hi there everybody, I'm DeLegge with ETFguide.com. Now the Pimco Total Return Fund, the shareholders, are engulfed in this preponderance of circumstantial evidence that points to a colossal tax bill. What's the evidence, Ron? Well, not so minor things like massive monthly outflows, a fund manager change, already elevated portfolio turnover, and basically an unfriendly tax-structured financial product. And when we put all of these things together, we logically deduce that remaining shareholders who own the Pimco Total Return Fund in a taxable account are going to have a monster tax bill in 2014 relative to previous years. Now the Total Return Fund's annual report, which was published in March of 2014, when Gross was still the fund's manager, indicated that its annual turnover was a very elevated 227%. Now, portfolio turnover above 100% indicates heavy trading activity. We mean buying and selling by the fund manager rather than a buy and hold approach. Now, if 227% turnover was the fund's turnover with Gross at the helm, what about now? According to some estimates, the Total Return Fund might suffer withdrawals up to 2/3 of its assets, pushing portfolio turnover above 400%. Remember, the cause of all that ugly turnover will be selling by the Total Return's new fund manager to meet shareholder redemptions. Another measure of the Total Return Fund's tax efficiency, or lack of it, is something called the tax cost ratio. Now, like a mutual fund's expense ratio, it simply measures how taxes impact a mutual fund's performance. The higher the tax cost ratio simply means the bigger the bite on a fund's performance due to taxes. Now, over the past 3 years, the Total Return Fund has averaged a total tax cost ratio of 1.49%, according to Morningstar. Now, that basically means that the Total Return Fund shareholders have lost about 1.5% of their assets to taxes on average. It's not an insignificant number, especially when we factor in another close to 0.5% of annual expenses for the institutional share class of this mutual fund. So investors who own their share classes pay even higher fees, so the combined expenses with the tax cost ratio push expenses above 2%. So it's important to remember, the tax bite facing total return shareholders that decide to remain in place isn't a problem exclusive to them, but a problem facing all investors that choose to invest in mutual funds. The fact is, redeeming shareholders can impact remaining shareholders with their selling. That's a major structural flaw of mutual funds that doesn't exist with ETFs. Who in their right mind would design a financial product where the selling of one shareholder impacts another's tax bill? It's crazy. The bottom line is this: tax efficiency was never the Total Return Fund's forte when Bill Gross was at the helm, and now that he's gone, the immediate tax situation for remaining shareholders will not be any better. I'm DeLegge. Thanks for watching another episode of Marketplace Minute.